Morning, coach. How are you? Sorry.
I'm fine. I'm fine, Victor. How are you? How is Harare?
Harare is well.
And my crocodile.
Yeah, your crocodile is very well, safe.
Okay, that's good. That's good. Look, how is
Morning,
Botswana?
Botswana is good, coach. It's a bit cooler because of the winter approaching, so it's okay.
Yeah, okay, that's good.
You can't really complain. Yeah.
We haven't met for 1 week now. Do you realize that?
Yes. You haven't met for almost 1 week.
Yeah. So today I'm not going anywhere. I'll just be home. So when we are done with this particular class, whatever time, I don't know what time you'll be ready, Victor, even later in the evening, again, we can continue.
I think that's okay. No problem. It's okay with me.
Today, I've just dedicated my time I'll be just home. Okay, so first, I'll do a bit of some storytelling on the changes in group structure. Then I know you looked at the video, but sometimes a lecture that you are not part of is maybe difficult to understand than where you have been actively involved and asking questions. So we'll actually look at all those progressions, then look at plausible scenarios or examples. So the first thing that we did on IFRS 10 was to first understand the basics of group structure. We understood that there is a possibility that a company can buy more than 50% shares in another company. So if that possibility exists, then it actually means that that company that has bought more than 50% of the equity shares will be regarded as a parent company. Therefore, the company that has less, I'm busy here. This is a problem of working from home. Bye, close there. Okay, so we are saying that that company that has bought more than 50% of the shares will be regarded as a parent company, and the company that has been acquired will be regarded as a subsidiary. But even those equity investors who have actually bought a minority of the shares will be regarded as what we call the non-controlling interest. So that was the first scenario. Then we went on to look at another scenario. The other scenario, which is also plausible, was that there's a possibility that the company that has been acquired can acquire another company and buy shares more than 50%, because that company is regarded as an independent and a separate entity. It has its own ambitions and life, so it can decide what to do. So in an event that this company that is a subsidiary buys more than 50% shares, that company that has been acquired by the subsidiary company will be regarded as sub-subsidiary. And because you as a parent company, you are a parent to the subsidiary company that also acquired the shares in another company, you will be mandated based on the shareholders agreements and all these other things with other investors. You'll be mandated to consolidate the financials up to the sub-subsidiary. So that was the first scenario. But there was also another scenario where the subsidiary acquires shares, and maybe not more than 50% shares. The holding company as well acquires shares in the sub-subsidiary, but not also more than 50% shares. But when you collectively add these shares, they give them a majority shares in the sub-subsidiary. Therefore, that sub-subsidiary will be regarded as acquired and being controlled by the parent company. And such techniques, they actually happen. They usually happen in the corporate world, where the parent company whispers to the subsidiary company that we need to disguise this. So how we are actually going to mask it, that people do not see our true intention that we are acquiring this company, is by you, the subsidiary, buying less than 50% shares in this particular company that we are targeting. We'll also buy some shares, direct shares in there, as maybe we'll just buy 40% of the shares in this company that we're targeting. And we are asking you to only buy maybe 20% of the shares in that company. And because we have 80% of the interest in your company, it means that we are going to have indirect interest in that company of 16%. Because you're buying 20%, we have 80% of your what? So it's 80% and 20% gives us 16%. Plus the 40% that we have actually bought directly in the 40% that we have bought directly in this particular company's stake. It means that effectively we will have 56% shares, and then we will have the control, because what we want is control. Not significant influence, but control. So that was the scenario that we looked at. So we looked at all these plausible scenarios that would actually happen without any surprise in a business environment. And we know how to account for them. But we did not stop there, and this is what we are looking at now. So we are looking at changes in the group structure. What does it mean? There's a possibility that the company can start with zero control in another company. And anyway, that is the most common feature. Then this company decides to buy less than 20% of the shares in another company. And that business scenario is basically regarded, obviously it will not be under the associates, it will still be under the IFRS financial instruments. I'm in class. I'm in class.
Yeah, it must be on quality
I'm in
side.
class, take right. I'm lecturing. I'll call you. Okay. Sorry. Sorry about that. Are you able to hear me? Am I clear?
Yeah, we lost you for.
Yeah, there's
For a
someone.
sec.
There's someone who called, so it distracted me. So we are saying that it is possible to start from zero acquisition where you haven't acquired anything in another company. Then maybe you acquire 10% or 15% shares in equity shares in another company. That now moves you guided under IFRS 9. It's just basically an investment of financial asset. Then now you transition. You can then now buy maybe from 20 to 50% of the shares in this particular company. Then you're moving now from just a financial assets guided by IFRS 9, or those days we used to say IAS 39, to IAS 28, which is under associates, or to having joint control, which is guided by IFRS 11. So you have both shares, but you don't have the majority shares. The only thing you have is significant influence, because you are able to guide or to be involved in financial and operating policies of that particular company, but you do not have control. But then you can now move from the 50% or 49% shares that you had, because you're a company who has its own ambitions. You have your own ambitions, business ambitions for that matter. So you can move now to acquire the majority shares. So you have moved from 49, 50 to 56 or 70. At that stage, when you actually cross the accounting boundary, those boundaries that we have from 50 now to 52, 50, whatever percent, it means that at that point, you have control, Victor. And if you have control, then we will need to compute goodwill. But then even when we are doing that, the first assumption that we are going to give is that we are disposing your initial relationship. Then revalue what we have disposed so that it becomes a part of what you are acquiring now and giving us an opportunity to compute goodwill. The way I always put it is, before a white man came to Africa, we still had the marriages. People used to marry off each other. Isn't it, look? But
Yes,
unfortunately, when this white person came in, the white man came to Africa, told us our marriages were regarded black, therefore needed to come up with what you called white weddings and all these things. What's more, up to this date in Africa, those marriages which follow the native template are now regarded as traditional marriages. Then these other ones, I don't know what they regard them. Like they are that's a real marriage. So if we decide, okay, we will not go for that, the European or whatever, and we are together. And maybe we have children. Then later on, because of the pressure from the families that no, we have to go Western. Then now you call Roque, you call Victor, you call all these Mary, Brenda, and everyone else part of this wedding. Then you sign, maybe it goes now to the court, registered in high court or whatever. At that point, then the court, or from our Western definition, is that now at that point, you are formally married. But does it mean that those children that you had before this particular whitish thing that you went for, does it mean that you ignore them? What it means from the logic now that you're looking at under changes of changes of group structures, it actually means that we are going to, on paper, we are going to like dispose, and we'll bring them at fair value because there are these costs that you are paying. So if we are able to generate and determine those costs at that level, say this is so much that we paid it through the traditional way. We are going to bring it back, but we're going to revalue it to today. to what makes sense today. Plus this now that we have been charged going for this particular white marriage or whatever it is. So we'll add these two minus the net assets at this time that we are acquiring now, formally acquiring based on the definition that the world has given us. We'll be able to compute goodwill. But it doesn't mean that we're going to ignore all the things that we did. All we're going to do is that we are going to, yes, we knew the cost, but at the time that now we have formally done these things, we are going to recalculate, revalue, and add whatever charges that have been given. Hello?
I lost you, coach.
Yes,
Someone again was
lost
trying
you.
to call. And this is one technology that they have to improve, where if you are twittering, there should be a way in which you can stop calls or whatever. I don't know. Maybe it's there, but I don't know. So that it doesn't distract us. So that is, I don't know if you understand this concept. What we're actually saying that, yes, we had these programs, we had bought 10% shares, we were actually under IFRS 9. We went on, we even actually bought maybe 30% shares in this particular firm. We actually now we're guided by IS 28 on associates. Then eventually now we have crossed this accounting boundary and we have the majority shares. And then we need, because it's us now to do the consolidations and all these things, we need to calculate goodwill. So all we are actually doing, we have recognized the cost that we incurred during these business arrangements that we had. But now we are formally in control. So we're going to revalue all these other business, whatever we had, and the cost, we revalue them to today, plus what we have been charged as an additional investment, which has given us control. Less the net assets and adding any NCI that now we have, we get the goodwill. Does this concept, is this concept logical?
Yes, it is, coach.
Yeah, yes, it is. We're following through.
Then there is also another, because remember that amongst them, amongst these entities, like I had already said, they have ambitions. They have profit ambitions. They are driven by the appetite to maximize returns. So even after you have become a parent company and you have acquired, say, 70% of the equity shares in this particular company, you still have interest to acquire more. So if you acquire more from, say, 70% to 80%, that is just change business transactions amongst the investors. It does not change anything. You don't need to start recalculating goodwill, because it just takes a 10 to this group, if it's the parent company, and reduces on the NCI, or it takes to the NCI and reduces on the group, whatever. That's the first scenario. The other scenario is that you have 70% of the equity shares. And you see no reason why you should hold on to all those shares, but you still want to be a majority shareholder anyway. You can retrench some of your equity shares. Maybe retrench about 15% of your equity shares, and you remain with 55% of shares. So what does it mean? It means that the NCI amounts will go up, whereas yours will go down because you're retrenching. Yes, you're going to receive cash, which you are going to debit. But then we also need to credit the NCI. But will not end there. There should be a balancing figure. Wherever that balancing figure is, we should find it between the actual money that has been banked, which we have debited the bank, and what we have credited, and the amount that we have credited through our computations, what we have credited to the NCI. That difference is what we are going to actually call the other components of equity. So the other components of equity, it will find itself in a reserves or any kind of that form, some form of reserve. And we are going to call it OCE, other components of equity. That is where it is going to go to. That's a balancing figure. Because as we're making these adjustments, after we have crossed the accounting boundary, as we're making these adjustments, they will need to be officially recorded in our financials, in our financial system. Maybe you have signed, you have Oracle. I doubt if Pastor can do that. Sometimes I don't regard it as an accounting package. So that difference has to be adjusted, or that transaction which has caused those adjustments has to be recorded. But as finance people, you will know that when you're trying to correct anything that you want to correct in the system, there's this thing you call journal. So there will be journal entries. Those days I never even understood when I came to head office. When I came to head office after I was transferred from Livingstone, I worked in Choma for about 2 years, then came to, so here, JVs. What are these JVs at accountants? Sometimes you ask even the accountants, what are these JVs? They also don't know. You just say, can you tell me what a JV means? We used to hear, no, pass a JV. It's basically we are saying make these adjustments because of these new things that are happening outside the system. So that is also another plausible business scenario. But another one, which obviously is final now, is where you have control, yes. You have 70% of shares in this particular company, and it's a subsidiary, at least up to this stage, guided by IFRS 10. Then you decide that you are going to retrench about 35% of your equity shares in that subsidiary company, meaning effectively you remain with 35, meaning that you have also now crossed that accounting boundary. You are moving now from control to just having significant influence and being now guided as an associate. So what accounting transaction do you think is going to be there? It will be just a question of knowing whether there was a profit or loss on disposal of these acquisitions. So the first thing that we need to know is what's the value of the shares that you have remained with in there? What's the value of the NCI that is remaining there? How much proceeds have you made in there, the cash? Or add them and put them aside. Then we look at issues like net assets. So when we do the difference, we will know whether there was a profit or a loss on disposal. Because all we're trying to do is that to first find what's the value of your assets. Had you not sold these things, what's the value of your assets? Your proceeds, what you have remained with, the NCI against the value of the book value of this particular entity. So when you do these differences, we'll find whether there was a profit or a loss on disposal, which then now we are going to transfer directly in the income statement. Then there's this thing, because like I said that if you are actually moving, if you are actually moving from not having control to having control, the first thing that we do, and this is an assumption, we'll assume that you have retrenched or disposed your previous relationship. Then you revalue that previous relationship to date. Then you add your additional investments so that you complete your goodwill. But even when you do that, if you don't make one most important adjustment, you are still not going to balance your balance sheet. Do you know why? Because the value that you are using to recompute your goodwill is revalued, is different from the original value that is sitting in your financials. So that original value and what has been revalued, find the difference. That difference goes into the revaluation account, meaning then it actually affects your other comprehensive income. So it will go in the other comprehensive income as a gain or a loss. And that is a smart way in which you are going to balance your balance sheet or your statement of financial position, as you call it. I'm done with the storytelling. Now we can look at what has been prepared for us today. Was the storytelling okay?
Yeah, it was good. It was okay.
Yeah, that's all right.
So, okay. So changes in group structures. So today's lecture, business combinations achieved in stages, like I'd already explained. Acquisitions and disposals where control is retained. So when you're looking at advanced financial reporting, you should know that this particular topic on group accounts is the examiner's favorite. But at this academy, Coach Carter has already shown you on how to approach these questions or topics in a very methodical and structured way. I did demonstrate to you how you can use memory pegging, mind mapping in unpacking these basic group accounts questions. But the examiner would also want to test your understanding on business combinations that have been achieved in stages, which usually will be called the step or piecemeal acquisitions. So business combinations achieved in stages. In my storytelling, I'd already explained that you can move from zero and acquire shares. And we are saying a company that had 0 shares in company B, for example, decides to acquire shares in piecemeal over time, that company can lead into an investment in equity instruments. This actually means that the company has acquired maybe less than 20% of the shares, because rule of thumb dictates that any equity acquisitions more than 20% and below 50% will be actually managed under IS 28 as associates or maybe joint control, which is IFRS 11. So equity instruments are guided by IFRS 9 which is financial instruments. And if it remains on the same acquisition trajectory, it can even become an associate and then a subsidiary. Like I did actually mention that the company has profit ambitions. It's driven by a huge appetite of maximizing returns. Therefore, it can move from just being and having an investment in equity instruments or financial assets to being an associate and eventually a subsidiary. So I advised my team here to comprehend the concepts and competently deal with each of these situations. And when you are looking at these situations, do not look at them from a textbook mentality. Just look at them memory pegged with life. Then it becomes easier to use those concepts that life has given to us. So you may sometimes see the term trade investment or just financial asset instead of investment in equity instruments, which I had already mentioned that this is managed under IFRS 9. In my storytelling, I touched on these three possible types of business combinations, where you have previously held interest, say maybe just 12%, with no significant influence. So if you do not have significant influence, then you accounted for under IFRS 9. Then you increase to a controlling interest of 50% or more. That's a first scenario. The second scenario is where they have previously held equity interest. You have significant influence, meaning you're being guided under IS 28 as an associate, and you have increased to a controlling interest of 50% or more. That is another scenario. The third one is where you have control. Control hasn't reduced whatsoever. You still have control, but you have moved maybe from 60 to 80%. And in my storytelling, I did explain this. So the first two transactions are treated in the same way. But obviously the third one is not, like I said. If you're moving from 60 to 65, we will not start recomputing goodwill. No, we will not. The only thing that we'll do that is going to affect that movement is ideally the NCI. So we'll show whether the NCI has gone up or has gone down, and cash. And any adjustment that will be made, which is basically a balancing figure, that will need to be taken to other components of equity. And that's the reason why the first two are treated in the same way, whereas the third one is not. So the general principle and this again in my storytelling, I had actually explained it. Under the revised IFRS 3, we know that IFRS 3 looks at business combinations, and this is what actually gives us the guidance to compute goodwill. You know what I've always said is that financial reporting, whether you call it advanced or whatever, is the most easiest. For a simple reason that there's someone who has given you a step-by-step instructional manual called the IFRS. So the only thing you do is that you just check that financial instrument, that manual. And most of the things that are there, if not all of them, they are all logical. So saying IFRS 3, a business combination occurs only when one entity obtains control over another. And this is what we have said, that any movement or increase of shares from 56 to 60, it does not change your control, and you don't need to start computing goodwill. You already have control, and that control is 100%. But the only thing that is going to change is this value or the quantum of the NCI and your bank on top. And this is why you do those journals or JVs. So we're saying, which is generally when 50% or more has been acquired. When this happens, the original investment, whether an investment in equity instruments that is guided by IFRS 9, and you have no significant influence whatsoever, you are not an associate, or you do not have joint control, it's treated as if it were disposed of at fair value and reacquired at fair value. Let me explain this. In Zimbabwe, there was a party that was founded by great Morgan Tsvangirai, and it was called Movement of Democratic, it's MDC, Congress. After, and Morgan Tsvangirai, why I say he was so great, was that he stood to the bullying of Uncle Bob. But after his demise, there was a young man that took over by the name of Nelson Chamisa. And they went on with the MDC brand. Until a few months ago, Crocodile and his own cronies decided to frustrate the efforts of MDC by forming splinter groups and going for legal issues and all that. There were so many people that showed that they had the ownership of MDC, who were obviously bought by the Crocodile farm. So what did these guys do? This is what we're looking at here. They retrenched or disposed of the MDC. But in real life, that wasn't disposed of. They knew that this is just a name. MDC lives in the lives and hearts of people. We then now going to call it Triple C. And at that date of acquisition, whatever cost they paid the office of the registrar, whatever, that registers clubs and all these things, was a new acquisition. But what they did is that they still carried 100% or at least 100% of the membership they had when they were called MDC, when all these other people who are actually in the business of being used by governments. So they came up with this triple C. There was a new cost in coming up with that triple C because they needed to pay this and that and that. But they revalued what they had retrenched as MDC, and that membership still came in there. This is what we are saying here. Victor, are you getting me?
Yes, I'm getting you, coach.
Mm-hmm. Is the memory pegging perfect?
Yeah, it is. I see you follow Zimbabwean politics.
I do. I know almost all the characters that are making noise and making news there. Yeah. So now, this is what we are saying here. When this happens, the original investment, whether an investment in equity instruments with no significant influence on an associate, is treated as if it were disposed of at fair value and reacquired at fair value. Always think of the MDC disposing it and reacquiring it at fair value, and now you're coming up with the new thing that you're calling as triple C. But if the 50% boundary is not crossed, meaning you have just gone up to having significant influence, you do not have control because you haven't crossed the 50% boundary. The event is just treated as a transaction between owners. That's it. So whenever you cross the 50% boundary, you revalue, and the gain or loss is reported in profit or loss for the year. Whenever there is revaluation, it means that it is going to affect other comprehensive income. And if you don't look at that component, you are not going to balance your balance sheet. So you need to look at the original cost or what was sitting in the books against your revalued amount. That difference, whether there's a gain or a loss, please take it to the income statement under other comprehensive income. So let's look at the Deloitte guide so that it helps us visualizing the concept of the accounting boundary. Guys, I want you, when this question, any question on IFRS 10, you even do it. You can even do theories so that you accumulate more time and go for it and make sure that you follow stage by stage and get everything there. So this is a Deloitte guide. So it shows moving from 0, if you have any shares between 0 to 20 investment in another company, it means that you have passive investment. You are passive because you do not have significant influence or joint control. You will be guided by IFRS 9 in financial instruments. I know as we start looking at standards, we will also look at it. We have no problem with it. But any shares between 20 and 50%, it gives you significant influence or joint control, depending on your shareholders agreements and all that, whether it's managed by IAS 28 or managed by IFRS 11 or joint ventures. At least joint ventures, we looked at it. But then when you cross the accounting boundary, now you have gone into IFRS 10. Now you're looking at group accounts, look. And this is why you look at the acquisition of a controlling interest in a financial asset. Acquisition of a controlling interest in an associate or a jointly controlled equity at 50. So you're moving from passive to significant influence or joint control, and eventually to control. So I want, when there are those theories that they'll be asking you, visualize this thing, even draw it and explain. I've told you one thing, if there's anything that is easy to trick, if there are any group of people that are easy to trick, examiners. Markers, actually. So where an interest in a subsidiary is increased from, say, 60% to 80%, does not involve crossing that all-important 50% threshold, which Robert Mugabe made sure that Tagarai never crossed it, because they had to count votes for over 1 month. And he knew the results. You had to fix him. We hope Crocodile doesn't do that to Chamisa. I want to see fair and fair elections. They may take 2 months, they're accounting
Counting votes.
Yeah. So to make sure that no one crosses that 50% mark. Because at that point, actually, when you look at the concept of these constitutions, they follow this same concept. If you have less than 50%, you may just have significant influence where you make noise because you're a politician. The moment you have more than 50%, 50% plus 1, as they call it, then it means that you have control. So likewise, purchases of stakes of up to 50% do not involve crossing the boundary, because you haven't crossed the boundary, you're just 50, and therefore do not trigger a calculation of goodwill. We had already explained this. This is Coach Carter's exam emphasis, that if you come across a question, the business combination achieves in stages, always ignore all purchases made before control is achieved. This is if the purchases bring the total holding to less than 50%, and I've already explained this. So let's look at the scenarios. Step 1, acquisition. An investment in an entity, or in practice be bought in stages over a period of time. So we are now moving from no control to control. So the accounting treatment is to treat the original investment as being disposed of at fair value, and reacquired at fair value. We are disposing MDC and acquiring it at fair value. The fair value on reacquisition. The fair value on reacquisition plus the extra consideration paid for the additional new shares bought becomes the cost of the increased investment. So 1, we remeasure original investment to fair value and the gain to profit or loss. Otherwise, if you don't look at the gain to profit or loss, we will not be a financial modeler. So I'm always preparing these financials up to the cash flows. But if you don't include that component, you're not going to balance your balance sheet. Because what is sitting there is an old figure. The figure that you are using now to recompute your goodwill and all those things, it is adjusted. Therefore, any difference, let it go into the income statement through profit or loss and comprehensive income for sure. So this is how it is. It's the cost of additional investment, like I'd say. So CCC, they go, they pay the registrar of companies or clubs or associations, plus what they have revalued, which they had as MDC, plus if any other interest that is coming in from non-controlling interest, less the net assets at acquisition, and boom, we get a goodwill at acquisition. So let's look at this example. Then I'll give you a classwork. Mhm. So say we acquired 38% of the equity interest of Calendar for 46 million several years ago. Mhm. On the 1st January 2017, say we acquired an additional 35% for 54 million. So we know that additional investment is 54. It's 54. But we want to know, this is basically on your fair value consideration. This is basically the actual cash. It's an additional investment. But then we have also fair value on revaluation, what has been revalued. This is basically on existing. Mhm. So when the fair value of the identifiable net assets were 100, so I'll put it here, NCI at acquisition, we have 100. Oh, this is basically the net asset, sorry. We'll do it like this.
I was now confused.
So do like this, or do like that. The fair value, the fair value of the non-controlling interest on 1st January. Okay, this is net assets. Then just redo like this, net assets. The fair value of the fair value of the non-controlling interest on 1st January 2017 was 27. So we have the NCI here, which is 27. Of the original holding was 43. The fair value of the non-controlling interest on 1st January 2017 was 27 million. The fair value of the original holding, this one, was 53. Because you have revalued.
Difference between here.
Yes, that's the one that goes into your profit and loss. So down here, you'll get your goodwill. Then the difference between this, which is 4, 7, 7 is basically a gain, isn't it?
Yes.
Which goes into your P&L. Then the goodwill here is how much?
34.
How much at the 4?
34.
34, okay. From let me do this. I'll give you one question. So I'm just giving you 5 minutes. You do the first question. And you explain to me afterwards.
Okay, exercise 1. Is that the one we did?
Yeah, exercise 1.
Yeah. Jeremy acquired 40% of the equity interest of David for 40 million several years ago. On the 1st of January 2015, Jeremy acquired an additional 35% for 45 million. When the fair value of the identifiable net assets were 105 million. The fair value of the non-controlling interest on 1 January 2015 was 32 million, and the fair value of the original cost was 40%, or of original cost, 40% holding was 52 million. Calculate goodwill. So the first thing is the additional acquired, the 35%, which is 45 million. And then we add the original cost, the fair value, which is 52 million, the fair value of the original 40% holding. And then the NCI, non-controlling interest, which is 32 million. So if we add that, we got, how much did we get? I didn't add it at first. 45 plus 52 plus 32. 45 plus 52 plus 32. We get 129. And then we less the net identifiable assets, which is 105. And then we get a goodwill of 24. And then the 40% equity interest, the original cost was 40, and then the fair value now is 52 million. So there is a gain of 12 million, which goes to the P&L.
Sure. Thank you. Okay, so we get back to, let me go to another segment. So the other segment now, we have looked at one assumption or one scenario where you're actually moving from no control to control. And then now we know how to compute that. First, the thing that we do, we compute goodwill and do other things, the NCIs, the normal things that are supposed to be done. That's okay, and that's fair play. But then we're actually going to another scenario, which is again possible, where there's just change in ownership. It's control to control. You're moving from 60% to 70%, or from 70 to 80%. So if there's any increase in control, it means that there'll be a reduction in the NCI, isn't it? So if we are moving from 70 to 80, it means that the NCI has actually moved from 30 to 20. So any reduction on the second half of the balance sheet, it means that those elements found on the second half, the affected elements found on the second half of the balance sheet, they will need to be debited. If that is true, then we are saying any reduction in the control, it will reduce NCI. And for us to make relevant or meaningful adjustments, then it means that we'll have to debit NCI. We'll have to debit NCI. We'll have to debit other components of equity because they are in the same category. They're on the last half of the balance sheet. And because we are acquiring shares from 70% to 80%, it actually means that we'll have to spend some form of cash. That is, if we are assuming that the consideration is cash in this case. If it was the shares or any other form, then we'll need to actually credit that. But in this case, let's make our example very basic. We are acquiring shares and we are going to pay in dollars or in kwacha or in pula. So it means that we'll have to credit bank. So here you have not acquired the subsidiary. It is control to control. You're just increasing your stake. There will be no gain or loss to be calculated. It's just a transfer between owners. Let's look at the example. Continuing from example 1. On the 1st December 2017, Sewa acquired a further 7% of Kavinda for 8 million kwacha. Kavinda had made profits since being acquired by Sewa of 10 million kwacha. There has been no impairment of goodwill. Prepare the journal entry to record the change in ownership from a 73% holding to an 80% holding. So the first thing that we'll have to do is to determine what was the NCI, total NCI, before changes were made. So the first thing that we'll have to do is determine total NCI before changes. That is what we need to do. So here we know that what was the NCI at acquisition. So the NCI at acquisition, how much was it? It is.
Should be 27, right?
Okay, then just check. The fair value, yes, 27. So we have 27. Then we need to find the post-acquisition, the NCI. Which is basically at post-acquisition. So literally, when you're looking at NCI at post-acquisition, you're basically looking at your profits that were made after you acquired, after the company was acquired. So we had 10 million. 10 million times, what was the NCI percentage then? 100 minus 73, what do you get?
27.
27. Sorry, 10, which is this 10 times 27%. Do not get a calculator, please. Don't get a calculator, look. It's 2.7. giving us
29.7.
29.7.
29.7. Right. So this is before changes were made. So I always go back to my grade 3, is it grade 5 computations? I found that method working for me, and it's more logical than going the other way. I always don't want to complicate things. So I'll say this 29, because we want to make adjustments, 29.7 was the time that we had the 27% shares. Or the NCI at 27% shares. So we are only looking at, because the other components are already there. This component is already there. We want to make this adjustment. Are you getting me, Tim? We want to make this adjustment. This one is already there in the system. It's already there in Oracle. It's already there in maybe Pastel, maybe not. But it's already there in Sunny. It's already there in all these other accounting packages. We want to make that adjustment. We want to pass a JV. So we'll have to pick the 7%, isn't it? So that we see what is this 7% of that, which we need to make adjustments. I don't know the other better way of doing it other than going back to grade 5. So I'll do like this because I don't know. So there'll be cross multiplication, which will be there now. It's very basic, but I'm sure it's easy to understand. Which will be 29.7 times 7%. Divide by 27%. What value are you getting?
7.7.
7.7. So then now we need to make a journal. So we know that now the adjustment that we are going to make, because the shareholding has increased, meaning that this is going to be reduced, isn't it?
NCI reduced by 7.7.
Yes. So if NCI will be reduced by 7.7, but then also this part, this is the cash that we have because we have spent in acquiring this 7%, isn't it? We have financed in acquiring the 7%. So then it means that we are going to say debit NCI of 7.7. Then down here, I'll say debit other components of equity, which is 0.3, right? Then debit, or then credit. Bank of how much? 8 million. Any issues?
No, no issues.
Nah, no issues.
Okay. So you go for another question. You do the classwork. Let me do this. Let me share. Like this. Sorry, not that. So the question reads, oh, sorry, not there. Yeah. Continuing from example 1, on 31st December, let me just keep that part so that you're able to see what is there. On 31st December 2015, Jeremy acquired a further 5% of David for 8 million. David had made profits since being acquired by Jeremy of $10 million. There's been no impairment of goodwill. Prepare the journal entry to record a change in ownership from a 75% holding to an 80% holding. So you can explain what you did.
Okay. Right. Continuing from example 1, on the 31st of December 2015, Jeremy acquired a further 5% of David for 8 million. David had made profits since being acquired by Jeremy of 10 million. There's been no impairment of goodwill. Prepare the journal entry to record the change in ownership from 75% to 80% holding. So what we did is we started by establishing the change in NCI. We start by identifying the NCI at acquisition, which is 32. And then NCI post-acquisition. We determined that by multiplying the 10 million that the NCI made, multiplied by the share, which was 25%. So we got 2.5. And then the total would be, in the NCI would be 34.5. Then we went on to establish the adjustment to NCI, which would also filter through to the journal entry. So we took the 34.5, multiplied by the 5%. The 5% is the amount that was acquired by Jeremy. The additional acquisition percentage of shares acquired, and then divide that by 25%, which was the original holding of the NCI. So of that 34.5 times 5% divided by 25%, we got 6.9. So our journal entries will be as follows. We'll debit NCI with the adjustment in NCI that we just determined, which is the 6.9. And then we credit bank with the actual amount that we paid for the 5%, which is 8. And then we debit other components of equity with the balancing figure of 1.1 to complete our journal.
Thank you so much and congrats. Let's go to another scenario.
Thank you, Coach.
Sure. So what we had looked at, so what we looked at just now was a scenario where the parent company is acquiring more stake in the subsidiary company. But the other scenario now that we are going to look at is where the company is shedding off or retrenching some stake in the subsidiary company without losing control. So it's control, that's a change in ownership, yes, but we are disposing. So obviously the double entry is going to be different, because if you are reducing your stake as a parent company, it means that the NCI is growing. That is what it means. So as you are shedding off your stake, it actually means that you'll be making money, and that cash will be debited. The NCI will be growing in size. Then it means that we'll have to credit the NCI, and any balance thereof shall actually be taken to other components of equity. So let's look at this scenario. It states Syria owned 90% of the equity shares of Mundi before it then sold 20% of the subsidiary on 31st December 2017 for 98 million. The net acquisition at the date of disposal of the shares was 350 million kwacha, and the goodwill on acquisition of the original 90% holding was 55 million kwacha. Prepare the journal entry to record the change in ownership from a 90% holding to a 70% holding. So the first thing that we'll have to do here, we'll need to get the total value of the company. So the total value of the company would be the net assets at the date of acquisition plus the goodwill, which is the original of the original 90%. So we'll have 340. So here, what we are saying is that is the net assets this is at acquisition or before disposal. I can even say at disposal. Plus the goodwill. So the net assets at acquisition was 340 plus the goodwill. Then we'll know the value of this particular thing. Plus goodwill of 55. Taking us to 3 95. So with this 395, the only adjustment we are making is to move from 90 to 70%, which is 20% shading off of the stake. So we need to find that 20% that we're shading off, because the other components are already there in the system. So we don't need to make any adjustments, which is how much? Isn't it not 79?
It's 79, yeah.
So this is the adjustment that we'll need to actually make in the system. So what we are going to do, because you are shedding off stake, you are selling part of your interest, it actually means that we are going to debit bank. We are going to debit bank with this amount, 98. Then we are going to credit NCI, because NCI is going to increase in size. We are going to credit NCI with a 79. Then we are also going to credit the other component of equity. What's the difference?
19.
19. This is how it is going to be done. Is it logical, Victor?
Yes, it is logical. But I've got a question here.
Please ask.
On the 20%, do we say 20% or we say 20 over 90? My assumption where I'm coming from is the 395. It's the 90%.
No, because what we are doing is that I don't think it should be 20 of the 90. Because all you're saying is that when you had that 300, the 300, yeah, when you had the 395 here. This is for the whole organization. Remember, goodwill, when you're computing goodwill, you're not only computing goodwill based on your stake, there's also a component of NCI in there.
NCI, no.
Remember how you compute goodwill, Victor. You have the fair value consideration, the cash that has been paid by the parent company. But you also have the NCI at acquisition, then less the net assets. So what you're calculating here, it's all at 100%.
Oh, 100%. Okay, I guess it's.
Coach, we are assuming that they use the total goodwill method, right?
Even if you don't use the goodwill, whatever, when you look at IFRS 3, whichever scenario you look at, that goodwill should be the same, because what you're looking at the full goodwill.
Oh, okay. All right, that's fine.
Remember, if we're to go by what Victor was thinking at first, here, these net assets, we're not going to look at the whole 350. We're only going to look at 90% of the net assets. But here we're looking at for the whole company is 100%.
Okay.
Even the goodwill here is also 100%. It's different from the scenario that we had looked at earlier on. where we are saying that to the NCI, this is the NCI, when their NCI percentage was this. Now that you're shedding off 5% or 7%, how much of that is being shed off? Then you say 7% over 25, whatever percent it is, times the NCI. But here, it's at 100%. Victor, does it make sense? Have I removed your discomfort?
Yeah. Understood.
Okay. So the example, the exercise here reads, supposed to be exercise 3. Betty owned 90% of the equity shares of Penny before it then sold 20% of the ordinary shares on the 1st December 2015 for 90 million. The net assets at the date of disposal of the shares were 350 million, and the goodwill on acquisition of the original 90% holding was 50 million. Prepare the journal entry to record the change in ownership from a 90% holding to a 70% holding. I'm giving you about 7 minutes. So, okay. You can continue.
So I had said the value of the company is 400 million.
Mm-hmm.
So the percentage which has been reduced was 20%. So 20% of 400, which is 80 million.
Mm-hmm.
So our journal becomes we debit bank with the money which was paid, which is 90 million.
Mm-hmm.
And then we credit NCI with the 80 million, and then the difference we credit the other components of equity 10 million.
Okay, thank you. So congrats, we now go to the last scenario. So now we go to the last scenario. The last scenario is where we fully lose control. That is what we'll be looking at. So the only thing that will need to be computed, because we have lost control, would be did we make a loss or a loss on disposal of this particular investment? So before we even look at this particular methodology of computing the profit or loss on disposal, what should get into our mind when we are looking at this is the concept: how do you calculate your profit and loss? First, we need to know what is the NBV at the time we're actually selling it, and how much did we dispose this? So if, for example, the net book value is 90 kwacha, and we dispose this particular asset at 100 kwacha, it all means that we made a profit on disposal of 10. So let's try to repackage this method here using this basic understanding so that we memory peg and we don't struggle in understanding what are those components that should be plugged in for us to compute profit or loss on disposal. So we have the proceeds. So whatever proceeds we have made from the disposal, we add the asset, we add the non-controlling interest that is coming from the other side. Then we have the net assets at the disposal, which is basically this NBV. We add the goodwill. So all we are actually saying here is that we have whatever we have sold. In here in the process, it's either you have actually been shortchanged or you have actually shortchanged the person that you have done business with. So we have the proceeds plus the investment is still existing because there's still a component of investment, if at all it's there, plus your investment still held. I'll just do like this, held, plus the NCI. So whatever amount that you're going to have here, this is more or less like your disposal. Though what you're trying to do, you're trying to calculate from the proceeds, but you cannot calculate just using the proceeds without having these investments and NCI. You are using them because the numbers that you have a lot of missing links, and you need to use this for you to see whether you're actually going to get a disposal. Then in terms of the assets here, your assets will be the net assets at the disposal plus your goodwill. Which this is your NBV of some kind. So what you're going to get will be either a profit or loss. Or loss on disposal. So this is how we are actually unpacking this whole thing. Does it make sense?
Yes, it does, Coach.
So the question reads, Kings owned 90% of Queens before it decided to sell a 50% stake of its investment on 31st December 2015 for 123. So we have the proceeds of 123 plus the NCI. The non-controlling interest at that date was 54 million, and the fair value of the remaining is 93. So we have the NCI of 54 plus the investment still being held is 93. So I'll add this plus 93 there. It gives us how much? Kindly add.
Uh, 270.
270. Then now we look at our goodwill. The goodwill at acquisition of 40. So we have the 40 here. Plus, and the net assets at the date of disposal were 205. So it gives us something that we can call as a proxy net book value of 245.
245. Mm.
So had we sold this particular investment, if we're assuming that this is what we sold and this is what was the book value. So had we sold all this, but we know that in there's just about 123 that was sold. We didn't have any other, we don't have any other metric that we can use to compete, because if we knew 123 and say, from this 123, what is the cost of the 123 is 120, then we are not going to look at all these numbers. So we're putting all these numbers in place so that we are able to determine whether there was a loss or disposal. So here we assume that suppose you sold the investment about 270 and the book value was 245. What would be your profit? So here we sold this there. This is what we should have sold it. We have the difference of 35.
25.
25, huh?
Mm.
Of as again, as a profit, isn't it?
Yes.
In disposal. So what does it tell you? What was the value of the stake that was sold? What was the value of the stake that was sold?
245.
No. What was the value of the stake that was sold? I'm asking again.
The value of the stake that was sold.
Of the stake what was sold.
What was the par value? Par value. Of the stake that was sold.
Is it not 135?
Yeah?
No.
You haven't understood the concept. The value of the stake that was sold, the par value of the stake that was sold is 98.
How did we get that?
The value was 98 of the stake that was sold, but somehow you found a way of selling it at 123.
Oh, okay.
Hello?
Yes.
But because the examiner did not give you these numbers, gave you these numbers to work, you know that thing we used to do in accounting, financial accounting, we used to say, is it a missing? Where you don't have,
incomplete records.
Incomplete records.
Yeah, I get where you're getting the 98 from. So we are just saying the 123 less the profit that we made. So the profit is 25. So we say 123 minus 25, then we get the 98, which is the par value of the stake that was sold.
Because you see, for you, you sold at 123. There was no any other way in which you're actually going to get this 25 without bringing in all these numbers. So you're actually working with incomplete records.
Okay.
Does it make sense now?
Yeah, it does.
Yeah, it does.
So examiner could have added this par value. It's by default that you must state it, right, Coach?
No. Most they don't even look at it. But in an event that one asks you, you can even state and say the value of what was sold, the shares, was this.
All right, that's fine.
So example 4 reads, SOX owned 90% of MOX before it decided to sell a 50% stake of its investment on 31st December 2015 for 120 million. The non-controlling interest at that date was 53 million, and the fair value of the remaining 40% is 96 million. The goodwill on acquisition of the original 90% holding was $38 million, and the net assets at the date of disposal were $201 million. Calculate the group profit on disposal that will appear in the group financial statements of SOX Group for the year ended 31st December 2015. I'm giving you about 7 minutes to do this. You can take me through.
Okay. We were saying SOX, the example says SOX owned 90% of MOGS before it decided to sell 50% of its investment on the 31st of December 2015 for $120 million. The NCI at that date was 53 million, and the fair value of the remaining 40% was 96 million. The goodwill on acquisition of the original 90% holding was 38 million. The net assets at the date of disposal were 201 million. Calculate group profit on disposal that will appear in the group financial statements of SOX Group for the year ended 31st of December 2015. So here we're given proceeds of 120, and then we add investments still held, which is 96. Then we also add the NCI's interest at that date, which is 53, giving us 149. And then we add the 149 and 120 to give us 269. Then we less net assets at disposal and goodwill, with net assets at 201 and goodwill at 38, giving us a total of 239. So 239 from 269 will give us a profit of 30, which is our group profit on disposal that will appear in SOX Group financial statements as at 31st of December. Then as a formality, our par value would be, of the stake that was sold, would be 90. Proceeds of 120 less the group profit of 30 to give us 90.
Congrats. Thank you so much. So what I want you to do, I sent 2 questions in Excel. The one that has a balance sheet, and the other one is a statement of profit and loss and whatever. So what I would want you to do is that in your own time, I can leave you here. I can leave you on this platform. You deal with those questions, then you send them to me. They contain these same scenarios. Okay. Then later in the evenings, we can look at that question so that tomorrow we start another topic on IS-21.
Okay.
So thank you so much. But before I leave you, I'm sure you also need to rest. I don't know. You can start at whatever time, because I know that Victor, you have a commitment at 12. So whatever time that you're going to sit, you can look at those questions, whether independently or as a team. As usual, I want you to check out first.
Yeah, for me, it's you know what I'm liking when I went through those videos, I could get some, and some I could not. And then this morning when you were doing the storytelling, I picked some. But then after the story, the good thing is the memory pegging that you always talk about. After the story taking, when you now come to the figures, you can now begin to see those things. Oh, okay, this is what he was explaining. This is what he was explaining, and then for me, I'm finding it very easy.
Well, thank you, Victor. Look.
Yeah, I think I'll echo the same sentiments with Victor. I think just giving an example. When we did the first scenario where you are just shading a little stake, and then there's increase in the NCI. When I looked at the videos, I was going straight to just say 10 minus 8 and then get 2. But when we did here proportionate movement in the NCI, and I actually picked it from how you explained it further. So I think it does help us a lot to grasp the basics. When you do your storytelling, and then we put it into practice, and maybe look at the figures or any example thereof. But all in all, I think it's going on well. I think step by step, I'm getting the basics from the way you are taking us through the whole syllabus.
Sure.
Yeah.
Thank you so much. So see you later in the evening, but just do those questions so that I can see where you have the gaps, and we look at them, we close it up. Then tomorrow we start another topic. I'll send the notes for tomorrow, which is on foreign currency, which is basically IS-21. Thank you so much, and have a lovely day.
Thank you, Coach
All right,
Kata.
it's okay. Thank you, Coach.
Goodbye.
Goodbye.
Cheers, Victor.